In this video we will discuss about some more important terms used in inflation chapter. 1. Inflation tax. Inflation tax is the loss in purchasing power of money that people suffer due to inflation. In other words, we can say that inflation erodes the value of money, that is, the value of money declines during inflation. When prices rise, the value of money falls, so holders of cash can buy fewer goods and services with the same amount of money. This loss acts like a hidden tax, even though no tax is officially charged. How it works? The government may print more money, often to finance fiscal deficits. More money in circulation increases demand. Higher demand pushes prices up, that is, inflation occurs. As prices rise, people's real income and savings lose value. The government effectively gains resources, while people bear the cost. Conclusion. This is a situation of sustaining government expenditure at the cost of people's income. That is how the term inflation tax is also known as seigniorage. Now let's discuss about term seigniorage. 2. Seigniorage. Seigniorage is the revenue, or profit, that a government earns by issuing money, equal to the difference between the face value of currency and its cost of production. Let's understand it with one example. Example. Let's assume cost to print a 500 rupees note equals 5 rupees. Hence face value equals 500 rupees. Seigniorage equals face value. Cost to print equals 500 rupees minus 5 rupees equals 495 rupees. Now let's discuss another term, inflation spiral. 3. Inflation spiral. It is a macroeconomic theory explaining the cause and effect relationship between rising wages and prices or inflation. Inflation spiral is an inflation, price rise, caused by the mutual reinforcement of rising wages and rising prices. It is also called the wage price spiral. As rising wages increase disposable income, demand for goods rises, triggering price inflation. Similarly, rising prices of goods and services then demand higher wages, which leads to higher production costs and further increase in the prices of goods and services, creating a conceptual cycle. Example. Inflation in 1935 in the US economy caused by wage price increase. Now let's discuss another term, inflation accounting. 4. Inflation accounting. It is used by corporate profit accounting. When a firm calculates its profit after adjusting the effects of changes in the level of inflation, the process is known as inflation accounting. Such profit is called real profit of a firm. Now let's discuss another term, inflation premium. 5. Inflation premium. Inflation premium is the additional interest charged by lenders, banks, financial institutions, to offset the expected loss in purchasing power caused by inflation. It ensures that lenders earn a positive real return despite inflation by adjusting the nominal interest rate. Interest rate relationship. Nominal interest rate equals real interest rate plus inflation premium. Hence we can say that inflation premium is an interest rate charged by lenders. Now let's discuss two-term nominal interest rate and real interest rate, which is used to calculate inflation premium. A. Nominal interest rate. The stated rate on a loan or investment, like what a bank advertises, before accounting for inflation. B. Real interest rate. The rate of return after adjusting for inflation, showing the true increase in purchasing power. Hence we say inflation premium, or expected inflation rate, the extra return lenders demand to offset the expected decrease in money's value over the loan's life. Thank you for watching this video. In next video we will discuss about Phillips curve, reflation and stagflation.